We've got an Austin commercial real estate report for you. We're the Shapiro Group here in Austin, Texas. My colleague Lee Abraham. I'm David Shapiro. Let's dive in and see what's going on with commercial real estate. So we're going to go over some economic indicators, talk about multifamily, office, industrial, and retail, and show how all these different asset classes are performing.
So David, when we take a look at unemployment, that's really one of the leading driving indicators of the real estate economy. Unemployment in Austin dropped to 2.7% in December. That's outperforming the state of Texas, which was at about 3.9%, the nation, which was at 3.5%, as well as Dallas, Houston, and San Antonio, all over a 3% unemployment rate.
So Austin continues to be the darling of the nation. And it's really hard when you're here in Austin, you hear the macroeconomic things, everything going on in the country, and trying to make a decision on what's happening here in Austin. Because as we know, here real estate is hyper local. Job growth has softened, posting a 5.5% expansion in the last 12 months, still 150 basis points above the US rate, equivalent of 57,000 new jobs here in Austin.
So the key takeaway, it's not a decrease in the job creation, it's simply slowing down a little bit.
But still, lots of new jobs coming here to Austin.
And so when we take a look at where those jobs coming from, leisure and hospitality sectors are leading the gains. Just under 25,000 new positions, David, and that's largely driven by the major events that Austin's become known for.
I was recently at an economic forum where Mark Sprague was talking about Austin and how there's just not enough hotel rooms in the city, that companies like Dell, Oracle, Keller Williams, that are large nationwide companies that have their corporate headquarters here, there's really not even enough space for them to host a corporate event of, smaller business units. They do that all the time, but doing a company-wide event in Austin, there's just not enough hotel rooms still. So despite seeing all these buildings going up downtown, it feels like we're overbuilding, but we're not even caught up to where we need to be yet. We have way less hotel rooms than a city like San Antonio, for example. And so there's still room there. We can see that we're filling some of the roles, adding almost 25,000 jobs in leisure and hospitality. And that's a good sign. The remaining jobs came in some other areas, another 18,000 jobs in these sectors.
Yeah, so when we're talking about the pillars of our local economy, the educational infrastructure is huge, and also health services, David, becoming increasingly prominent. Those two sectors added about 18,000 jobs to our economy over the past year. So David, you read the news and, concerns, anxiety, nervousness, fear regarding the economy, particularly in Austin. There's inordinate degrees of exposure to housing and high tech. And basically what I'm saying there, nationally, these are two of the main trouble areas in terms of layoffs, things of that nature. Austin's in a stable position, sustained by its status as the state capital and also our strong educational sector.
I'll add that, when you say state capital, people underestimate how many jobs there are for the state of Texas. Heart of Austin's economic and job base is state, some federal, city. There's so many government jobs here. It's sometimes underestimated. Yeah, the tech sector's big. Yeah, we got a good education. There's a lot of, we're talking about just health services. So all these other sectors really play a role as well. But still, far and away, the most number of employees in this city are government related.
And one of the key things about that is the stability of that workforce. This is not a cyclical sector of the market like tech, for example, where you're currently in a little bit of a downslide. A lot of stability, and when we take a look at forecasting risk into the future, it's one of the key things that we keep in mind when we're crunching our numbers.
Yeah, government, I think it's traditionally stable, especially in a state where Texas, where the budget is strong. And so there's really not much risk for a reduction in force because of the cyclical nature of that sector.
Yeah, absolutely. So the takeaway is that although some tech companies have been cutting jobs, Austin has a strong presence in the sector, which is obviously on the surface potentially a source of concern, but it's not high on the list of places where these companies are looking to reduce operations. So when you take a look at the big picture, talk about some of the big company names out there, what's happening internally, does it necessarily translate to Austin? Not so much. That's the takeaway.
Right.
Okay, so now we're going to switch gears, David, and we've set kind of the backdrop of the economic outlook for Austin, very strong, stable, so forth. Now let's get into the various segments of the commercial real estate market and see what's happening here in Austin.
So Austin trailed the nation on a year-over-year basis, posting a 3.4% rent increase, while the U.S. rate deaccelerated to 5.5%.
Right.
So meaning that rents were going up by more than 5.5%. And so on a national basis, they come down to a 5.5% increase, still not a decrease, whereas Austin's a 3.4% increase. So we're on the lower end of how much rents are increasing, but they are still increasing.
Right. And so now when we take a look at those rents, the average asking rent in Austin was just over $1,700, and it's slightly above the national rate, which was $1,701.
Which is pretty interesting because people really feel like Austin has gotten so expensive. And the fact that we're only $27 a month more than the national average is pretty interesting.
Well, it's a recency bias as well. There has been a recent run up in the rent prices, and people are largely responding to that. But yeah, we're right on point with the national average, basically.
The average occupancy in stabilized property, stabilized means properties that are fully rented, not buildings that have just been completed.
Right.
Dropped 120 basis points in 2022 to 95.7% in December.
Yeah, so that's just under 96% occupancy. It's a very strong number historically, particularly when you look across the country at what's going on in other markets. So David, on this next slide, we can see the national rent growth rate for Austin versus the U.S., and it's an interesting pattern.
So Austin is the lighter blue here. So you can see this was going back to the bottom, says November 21 is here.
Yeah. Well, basically you're looking at kind of a cyclical nature, some of that seasonality. You've got the dip in the fourth quarter, January, November, March is where it begins to turn around. And basically my takeaway, David, is that we're right on trend. You take a look at the Austin trend versus the U.S., and there's nothing shocking. It's just kind of on trend with the rest of the country. And when we look at the average rent rate that we looked at before, which is also on point, it's kind of interesting. Austin is kind of right in the heart of the numbers here.
And this just shows transaction volume. If you're curious, East Central Austin is the highest transaction volume right now. If you've driven over there, you'll see there's some really big projects that are coming pretty close to completion. So that's pretty interesting to see. And it's just East Austin is now becoming a really hot multifamily market.
Yes. And the other chart there is fairly interesting as well. Once again, Austin basically on point with the national average for price per unit and going up steadily. And, we're forecasting that to continue. Now, here's the one potential red flag. It's construction volume in the pipeline. And so Austin's number one in the U.S. for volume of construction starts, just over 34,000 units, David. That's over 121 properties that broke ground in 2022, double the volume of the previous year.
That's pretty spectacular.
And so that is quite a market response to the demand for the multifamily assets.
Yeah. One thing I've often talked about is one reason real estate tends to be cyclical, in my opinion, is that you have all these individual actors making decisions on a broader market data and decisions that take years to pan out.
Right.
So when you're a multifamily developer and 3 years ago, you're seeing this demand, you start putting projects in the pipeline, but simultaneously 120 other projects are put in the pipeline.
Right.
And then all of a sudden they deliver around the same time. It creates this where, you can see that there's low supply, and then all of a sudden there's an oversupply. We're not saying that's going to happen here. I think that there's enough organic demand. And when I say organic, people often be like, what do you mean by organic? It means that people that want to actually move here, it's growing on its own, this city. There's jobs coming in. It's not, I always think back to the 2008-9 crisis when I would consider artificial is where you have a city like, if you would hear these stories about Miami, sometimes Vancouver, where there's international investors, they're just trying to place money in the U.S. and there's just empty condo towers.
Right.
That's not happening in Austin. You can see the occupancy rates are high. People want to be here. So this is organic. So I don't know that we're saying that it's going to be an issue, but you're saying this is one red flag where potentially there's a lot of building happening in this multifamily sector.
Yeah.
And we're not sure how that's going to pan out.
Yeah, I mean, it's all about supply and demand. This is the supply side of the equation. When we're representing our clients, we're taking a look at this every single day. And I'm going to tell you what, this is a great time to be an investor in multifamily. As things soften up a little bit, which they will as the supply comes to the market, there will be sellers that need to sell that are getting spooked a little bit. And you know me, folks, if you've been watching these videos for any amount of time, buy on fear. That's my guidance. We believe in the fundamentals, and I think multifamily is going to really open up some opportunities over the next 24 months, David.
Yeah, and talking about people having to sell, what's different about the commercial space from residential, people got these really low, under 4% interest rates. They locked them in, most of them for 30 years. Talking about differences from 2008 to today, 2008, a lot of people had adjustable rate mortgages.
Right.
Today, nobody would have been, whether it was the history of what happened, adjustable rates just weren't priced aggressively enough. It's like you could get a 3.25% 30-year fixed, or you could get a 3.125 adjustable rate. Why would you take an eighth of a point discount when you can get a 30-year fixed rate mortgage? So most people have a fixed rate mortgage for 30 years. That is different in the US than other residential markets outside of the country, to be clear. So the residential market is pretty well insulated from some of these risks, whereas the commercial lending space is much different.
Yes.
And in the coming years, there are interest rates that are going to adjust for commercial landlords. There are notes that are going to come due. There's going to be more forced transactions in this space, and there might be more chance for deals if you were a buyer.
Absolutely. Yes, sir. So, David, let's talk about the office sector. We mentioned layoffs, tech being an issue, not so much here in Austin, but it's something that we have to factor in. And, part of that is the flexible hybrid work policy, work from home. The bottom line is that there's a fresh wave of sublease availability, David, and that's going up in the first quarter of 2023. And as we look into the numbers, the sublease activity has increased 17.5% over the previous quarter after stabilizing in mid-2022.
So there's now more than 4.6 million square feet of sublease space available citywide, and that continues to trend upward.
Right. So when we look at net absorption, it's these sublease spaces that have basically pushed the absorption into the red. That's a negative for those of you taking careful notes. Approximately 395,000 square feet of negative absorption. That's more space than there was in the previous quarter. So what does that mean?
So citywide vacancy has increased from the previous quarter, coming in at 23.1%. And in the CBD, which is our downtown, jumped 240 basis points from the prior quarter, coming in at 21.4%. So interesting that there is more vacancy outside of downtown. So that still seems to be slightly preferred from companies wanting to office. They want to be downtown.
It's the Shapiro theory of real estate. Buy the best, ladies and gentlemen, because it performs best. Yeah. So when we take a look at what's on the docket going forward, we're looking at a rise of nearly 590,000 square feet of new office space to be delivered in the first quarter of the year, and then another 5.7 million square feet still under construction. So this is a red flag when we take a look at the vacancy rates of multifamily that we just talked about, dropping. Now we look at the vacancy rates of the office space moving in the other direction with some velocity.
Mm-hmm. Yeah, so just to be clear, so those vacancy rates are what's available for sublease. So there is an underlying company that's paying a lot of those leases so the landlord's maybe not taking the brunt of that right now.
In a lot of cases, it's a triple net kind of a situation where they're going to carry forward with their obligation. But I'm sure that there are some, operators out there that are feeling the pinch as well.
Mm-hmm. Yeah. Yeah, and again, at this economic forum, they talked about the number of buildings. It's like 50 buildings going up downtown right now that are either in some phase of development, design, construction. And some of these big towers have like 800, like Republic Square Park, there's a big tower going in right south of the park that's going to be a massive, like 800,000 square feet of office space. And there's another building that has around that much, I remember from the presentation. There's a building that's where the rail yard is currently, which is about twice this footprint of these other projects, that's going to have estimated 1.7 million square feet of space. So there's a lot that's in the pipeline when it comes to office in those towers. It's pretty
very interesting.
Okay, this chart is showing the vacancy rates for the different parts of town when it comes to commercial office space. So if we look on the right side, first of all, this top line is CBD, 14 million square feet of inventory. Vacant via sublet is over 700,000 square feet. And then direct vacant, over 2 million square feet for a vacancy rate of 21%. Central doesn't have a ton of inventory, but has the lowest vacancy at only 17%. And then far northwest would be the next spot where we have really high inventory total, but the vacancy rate is still relatively low. And then let's jump to the highest. So if you look at northeast here, 41% overall vacancy. So you as a potential real estate investor, maybe you're a business owner, you currently are leasing space and you're thinking, maybe it's time to buy.
Right.
So where on this chart could you go? So Northeast Austin has the highest vacancies, potentially the highest chance for a distressed seller,
right,
where you could go out and get a really good deal on a space.
So the bottom line is taking a look at this particular chart. When we look at that vacancy rate and we're trying to represent our clients that are the business owners that you mentioned, that are paying their lease rate, making the landlord wealthy, this is an opportunity to create wealth with real estate through the office. If you can be an owner-occupant, we believe there's going to be some real attractive listings out there for us to take advantage of.
Mm-hmm. Yeah, and if you're just a straight investor, 17% Central Austin. That's where the best vacancy is. East, interestingly, this hot market, I'd say for office as well. We talked about being hot for multifamily, but there's some really cool big developments going on over in East Austin for office. It has a relatively high vacancy rate right now. So that'll be interesting to track. I think there's a lot of tech companies that like being in East Austin. So still think it's desirable overall.
And we just did a redevelopment deal, office use for one of our clients. And there's some fascinating opportunities as that East Austin market transitions to the highest and best use currently versus the historical use. And a lot of interesting dynamics to pick apart when we're analyzing that market.
Mm-hmm.
So David, the darling of the pandemic real estate reaction has been industrial, and that strong demand remains, but new supply is pushing the vacancy rates higher, even in industrial. So there's an abundance of new supply, particularly in distribution, and it's pushed vacancy levels upward 250 basis points from the prior quarter.
The first quarter of this year, we had an overall vacancy in industrial of 7.4%, and warehouse distribution increased to 7.9%.
Right. So this industrial flex product that we've been hearing more and more about is doing quite well, David, with a vacancy stabilized at a healthy 6%.
So flex is an interesting product because you have these companies, maybe they're a startup, they have a warehouse space because they're fulfilling shipping, but they also need office.
Yes.
And so you can house both of those in one space. It gives you the flexibility if you need to expand. Sometimes there's space right next door you can expand to, whether it's you need to expand your offices or your warehousing. And so this has really been a cool product where the landlord can flex it too. Like maybe he gets interest from creative office where they want some cool office space. He can build it out that way. Doesn't necessarily have to be warehouse. And that industrial warehouse look, the price point is attractive for both use cases. So that's why this has done really well.
Absolutely. So when we're taking a look at vacancy, the flip side is absorption. And in the first quarter, it was mostly flat, but we are anticipating that the absorption is going to increase here in the second quarter because many of those large leases that were signed last year, David, are now fulfilling. Now they're coming to fruition and there's move-in and absorption. So we're looking for this to trend downward in terms of vacancy, upward in terms of absorption. So, despite recession fears, demand for industrial space across the region is strong. Leasing activity remains robust with approximately 683,000 square feet signed in the first quarter of this year, David. So that's pretty strong absorption numbers for the quarter.
The sustained demand for industrial space and an onslaught of newer warehouse and distribution assets has pushed asking rates to new highs.
Yeah.
So still not enough supply because prices are going up.
Well, the supply of new construction is basically what they're saying here. So newer warehouse and distribution assets, premium product, pushing the rates upward.
So like a Class A equivalent.
Correct.
So the warehouse and distribution continues to be the most desired product type, 11.2% increase year over year, with an average overall rate of $11.93 per square foot.
Yeah, so those are your top line numbers, and that really reflects the supply demand dynamic. And 11.2% is not bad.
And for those that are maybe newer to commercial real estate, we're basically talking about $12 per square foot, which is an annual rate.
Right.
So you would take that 12, multiply it by, let's say it's 10,000 square feet. So you get $120,000 a year in rent, which divided by 12 is $10,000 a month.
Right.
So it's $1 a square foot a month, 12 a year. That's how that works when you're talking commercial.
Right.
All right, so here we have the submarkets for industrial, and I mean we can just quickly look and see that north has the highest inventory, southeast is pretty strong there, and then we've got a lot in Hayes County, Georgetown, north, far northeast, and then east. Those are the areas. And in terms of vacancy, so the strongest market is Cedar Park, which has no vacancy, but not a ton of inventory. Right. If we go to the ones that are at least a couple million, right, you've got 1.9% here in far northeast. You've got 2.2% in northeast Austin, Round Rock at 1.3%. So those are some areas that are doing really strong. And then the ones with the highest vacancy is Georgetown, clear 25%, and then a runner-up would be Hayes County. So to my philosophy of buying the best areas, because those tend to do the best, and that's showing here once again where the further out Georgetown and Hayes are underperforming some of the Austin submarkets.
And when we take a look at some of these trends and what's required for these industrial spaces, more land, different type of infrastructure required. When we're looking at speculating on where the market's going, the path of development is pretty clear along I-35. There's plenty of opportunities now for portfolio diversification to speculate on some vacant land, unimproved dirt, that likely will be highest and best use industrial warehouse space, some distribution space as well. So this is kind of, from my perspective, a forward-thinking play for asset funds and portfolios, investors that are really looking to diversify with the future in mind. So now, David, let's wrap it up with retail. The Austin retail market was quite active in the first quarter of this year, with vacancy decreasing by 20 basis points quarter over quarter. Demand continued to push construction starts with 74 projects amounting to just under 3 million square foot of retail product currently underway. In the peak of the pandemic, this would be counterintuitive. And so this is very interesting information as we go through some of the stats.
In the first quarter of 2023, there was 10 projects, which collectively totaled over 200,000 square feet that were completed. And the triple net asking rent increased by $1.30 to $23.50. So triple net meaning, well, go watch our triple net video on this that we explain everything and talk about it.
So we're looking at the rents going up. Again, a great indication of supply and demand. And with a limited available supply, occupancy rates in the Central Business District, Southeast, and Bastrop County, submarkets all remained at 99% in the first quarter. That's ridiculously low vacancy rates, David.
Wow, that's pretty crazy. Not, like you said, not what you would expect.
Yeah.
Coming out of a pandemic.
It's interesting how things don't always pan out the way that, the thinking out there would suspect that they would. I mean, the retail has been a real wonderful story as we're in the post-pandemic recovery.
Mm-hmm. Yeah, it goes to the first level thinking versus second level. this different, progression, and how it is really hard to think through all the different
Yeah.
consequences of these different elements and variables and how they're all going to play out.
And that's one of the reasons we stick to the facts. We like to show the actual statistics and lead us to where the market's going.
And as you stated, it's going to follow the path of development along 35, where there's all these new housing projects, and that's where the demand's going to be.
The report came out earlier this week that that I-35 corridor has 4 of the 5 fastest growing cities in the United States. I mean, that's no joke. That is a serious driver of our economy. And it's hard to go wrong when you're looking at that I-35 corridor. Retail, specifically in proximity to where folks are living, is the key here. And it's an interesting market. So the bottom line takeaway is that the I-35 corridor, just saw a study the other day, 4 of the 5 fastest growing cities in the United States are along that I-35 corridor, Georgetown being number 1. It's a safe bet when it comes to retail if you know what you're doing. So David, as we take a look at the data that we presented here, we've got the 4 basic sectors of commercial market. When we start with the multifamily, seems to be fairly stable, maybe a little bit of a red flag on the horizon with the inventory coming to the market. Then we've got the office sector, clearly has the greatest number of red flags out there, high risk. And then we take a look at the industrial, not near as risky as the office, but the supply side is going to be interesting for us to track. And then retail, wow, we use the phrase counterintuitive, very, very exciting. I think there's some real investment opportunities for folks, particularly, again, along that I-35 corridor, to do quite well in the retail sector here in Austin.
Would you say mostly as like the triple net opportunities?
I love the triple net. Anytime you are the owner occupant of a retail space, different things happen. We did see that big downturn when the pandemic hit on retail. Obviously, the recovery happening now. Depends on where you're at. If you are leasing any of these spaces, if you own a business and you're leasing the office, retail, industrial, guidance is take a good look at being on the equity side. If you are in a portfolio management situation, then yeah, I love that triple net. I think that's really the way to go for a hassle-free, hands-off, solid return, blue chip sort of investment.
Yeah, we'll link in the description to our video on triple net so you can check that out. So make sure you focus on the fundamentals. We went through them here. We talked about vacancy rates, supply and demand as the drivers of vacancy. And we want to take that into account when we're making investment decisions, knowing that real estate is hyper-local. So digging down into the submarkets and making a decision on what's the best decision for you in terms of making that investment. Thank you for joining us on today's video. If you have any questions, please comment below with them. We'll jump on there and get those answered for you. If you got a lot out of this, share it with a friend. Give it a like so other people can find it as well. And we look forward to seeing you on the next video.
Thanks, everybody.